So hello, welcome back all. So today we are learning a new subject of equity investments. Okay, so this comes under Schweizer's number book 2, and it have a fixed income and equity investments. So equity investments are very much important. We will actually deal in equity investments mostly like 98 percentage. 2% only we will deal with fixed income securities on a daily basis, on a practical basis. Okay, so it's like more to like very easy, not so complicated. Let's deep dive. Okay, so here is the first chapter. So I'm referring to Schweizer's here. We will obviously look to curriculum, and rest we will make a separate video on the questions part. I will cover Schweizer's question, curriculum's question, blue box questions, and examples, and institute practice questions too. So as a CFA student, exam oriented, you just have to focus on the LOS. So we have A to L concepts here. So actually, what does CFA want you to learn from this chapter is very much important. Okay, so he on the first LOS we have explained the main function of the financial system, right? It's very basic. And second, we have classification of assets and market. Sounds cool and simple. Describe the major types of securities. How many types of securities are there? Currencies are there, contracts are there, commodities are there, real estates are there, which are traded in organized markets. Okay, major types. We will be learning about types, including their distinguishing characteristics and major subtypes. So we will be learning about their subtypes too. So this is LOC. We describe types of financial intermediaries and the services that they provide. So we will be learning about types of intermediaries and services that they provide, and we will be also learning on compare position and investor can taken in an asset. So an investor can take multiple position in any securities. So we will be comparing that too, and we will be calculating and interpret the leverage ratio, the rate of return on margin transaction, and the security price at which the investor should receive a margin call. So I think is that really the first? Yeah, and we will be learning compare execution, validity, and clearing instruction, and we will be learning compare market orders with limit orders. We will be learning define primary and secondary market. We will be learning describe how security contract and currencies are traded in code driven, order driven, and brokered markets. We will be learning on well functioning system characteristics. We will be learning on market regulation objectives. So we will be touching parts of like currency, real estate, every type of securities here. It's the first basic chapter, right? So let's deep dive. So LO sounds very basic and cool. Let's dig out. Let's see if it's that simple as we think. Okay, so it's reading number 39 on Schweizer's. So let's see. So first we will be moving to the first LOS here. So here we are looking into the market organization and structure part here. So module 1 39.1 covers on market assets and intermediaries. So LOS A actually is on explain the main function of the financial system. So I will be going line by line, covering each topic with real life examples and all, and I will be teaching in a way that you don't know anything. You are from a science background and haven't studied in UG, and I will make sure that after this video the first chapter is very well clear to you. So explain the main function of the financial system. So we don't have to study what is financial system, right? We already know that. Now let's know about what is the main function of that. So the main function of the financial system are allow entity to save and borrow money, raise equity capital, manage risk, trade asset currently or in the future, and trade based on their estimates or their asset value. So first main function of financial system is allow entity to save and borrow. So three main function, right? Three main functions are allow entity Okay, allow entity to save, to borrow. Now what all? To save, to borrow, to raise money, to manage risk. Okay, now to trade asset, or in the future, and trade based on their estimate of their asset values. So like, let's say an example, in Saroda you can add funds, in banks you can add fund, in bank you can borrow funds, in banks can raise funds, banks can have to manage risk, and they can actually trade assets. We can actually trade assets here. We can have a separate trading demat account, and we can actually trade assets. Now second is determine the returns, that is interest rate, that equates the total supply of saving with the total demand for borrowings. Now we had to determine the returns. Financial system had to determine the returns, that equates the total supply of saving with the total demand of borrowing. Now total demand of savings is equal to total demand of borrowing. This one's rate we need. We have to determine that. Third is allocate capital to its most efficient use. Now third is allocate capital to its best use. So first is allow entities to save, borrow, raise, manage, trade. Second is we have to determine the rate where the total demand of savings is equal to total demand of borrowing. Third is allocate capital. We just have to not to deep dive it, just to understand it. The financial system allows the transfer of assets and risk from one entity to another, as well as across time. Entities who utilize the financial system include individuals, firms, government, charities, and others. So everyone is included in others, right? So it includes everyone. Individuals is included, firms are included, governments are included, charities are included, everyone is included. Now, achievement of purpose in the financial system. What is the purpose that financial system is achieving? Financial systems allow entities to save, borrow, issue equity, manage trade risk, that is the actually function, and utilize information that we know. We have now studied. The financial system is best at fulfilling these roles when the markets are liquid, transaction costs are low, information is readily available, and when regulation ensures that execution of contract. So there are 4 points. When does the financial system functions its at best? When it's liquid, when its transaction costs are low, information is readily available, and regulation ensures the execution of contract. Now we are looking into one by one part. Now first we are looking into savings part. Individuals will save. Of course, we all save. We have to save. That example for retirement, and expect a return that compensate them for risk and the use of their money. Today I am not using my money. I am saving my 10% of my income of 1 month to my retirement. That fund, that amount I can use now and utilize, and could have utilized better. So I am expecting a good return there. I am not spending now, means I have got 100 rupees, that for 10 rupees I can spend and enjoy now. But I am taking a risk. I am saving it for my retirement. So I should be compensated with a better return. So I should expect a return that compensates. Firms save a portion of their sales to fund future expenditure. A firm always plans to grow, so they actually allocates their part of revenue for the future expenditure. Vehicles used for savings include. So how can we save? We all study in the CFA point in the perspective of the company. So The savings include we also stocks, bond, certificate of deposit, real estate, other asset. Every asset we can use for savings. Simple as that. Yes. This part is done. Now second part is borrowing. Now we are looking at the perspective of individual. Individual may borrow in order to buy a house, fund a college education, or for other purpose. We are taking a loan, right? A firm may borrow. Now a firm, why it borrows? In order to finance capital expenditure. A firm has to build a plant over there, factory over there, buildings over there, expansion it needs. So it needs to borrow. And for other activities. Government may issue. Now individual we have now looked upon a firm. Now we are looking on the government. Government issued to fund their expenditures. So everyone is looking to fund their expenditures. So why we borrow? To fund their expenditures. Lenders can require collateral to protect them in the event of borrower defaults. Now why the lenders are also can require collateral to protect them in the event of borrower default. Now everyone is borrowing, individual, firm, government. Now lenders may ask for collateral also. Lenders need security, right? Take an equity position or investigate the credit risk of the borrower. Simple. Individual borrows, firm borrows, government borrows. Now lenders can ask a collateral. What if you default? You are taking my money and you default. What will I do? I cannot see the sky, right? So I am asking for an collateral. It may ask, it may not ask. If it asks, it is secured. If it's not asked, it's unsecured. Now third point is issuing equity. Another method of raising equity is to raising capital is to issue equity. One may borrow, one may issue equity, where the capital providers share in any future profits. Investment bank help with issuance. Analysts value the equity, and regulators and accountants encourage the dissemination of information. So one may borrow, one can issue equity, and if the equity is coming from owner's side, they can have a part of more profits. Now the part of investment banks, like one is coming from with an IPO. IPO means they are raising funds from the market. Now there has to be a criteria of 70% at least should be issued. If 70% is not issued, the IPO is cancelled. So the company goes to investment bank. So they underwrite it. So they buy the IPO shares and sell at best commitment. So there are some methods, best commitment and all. So they will trade. They will themselves trade to best commitment, or they will actually buy all, or they will find some parties. So they will help with the issuing equity. So now the another portion is risk management. Entities face risk from changing interest rate, currency value, commodity value, and defaults on debt. Simple. For example, a firm that owes a foreign currency in 90 days can lock in the price of this foreign currency in domestic currency unit by entering into a forward contract. So they are talking about hedging. So we are talking about risk management. So risk management we are talking about hedging is the best instrument we can manage our risk. Future delivery of the foreign currency is guaranteed at a domestic currency set at the inception of the contract. In the transaction, a firm would be referred to as a hedger. I told you. This hedging allows the firms to enter a market that it would otherwise be reluctant to enter by reducing the risk of the transaction. Hedging instruments are available from exchanges, investments bank, insurance firms, other institutions. Simple, no need of any explanation. Okay, we talk about save, we are talking about borrow, now we talk about managing risk, we talk about raise. So we are more elaborating on the three main functions only. Now we are moving on exchanging asset, the last point of the function. See, trade asset, we told now. The financial system also allows entities to exchange asset. For example, Procter and Gamble may sell soap in Europe that may have cost dominated in US dollars. Procter and Gamble can exchange their euros from soap sales for dollars in their currency market. So they are talking about exchanging assets. So utilizing information also. Why the utilizing information came? We told that the best financial system should have low cost. You should utilize information and all now. So investors with information expect to earn a return on that information in addition to their usual return. Investors with information expect to earn a return on that information in addition to that usual return. Means I have some information, I know that this thing is most going to happen according to my expertise. I am expecting a return for sure. Investors who can identify assets that are currently undervalued or overvalued in the market can earn extra returns from investing based on the information if their analysis is correct. Suppose I am analyzing a stock and I came to know that this stock is very undervalued. Its intrinsic value is very high. Yeah. So I have that information. My analysis is correct, I believe. So I'm utilizing the information to gain more returns. Now, return determination. We told about the second part. Total demand of savings is equal to total demand of borrowing. That rate we should determine. So we are moving to that. The financial system also provide a mechanism to determine the rate of return that equates the amount of borrowing with the amount of lending in an economy. Same. Low rates of return increase borrowing but reduce saving. Low rates of return increase borrowing. Like I am issuing a loan at 6%. Sorry, 3%. So everyone will take the loan. Most will take the loan because if the unsecured loan I am talking, it will be more above than 9% only. So I am talking about 3%. So low rate of return increase borrowing but reduce saving. Now who will keep the money? Why I should keep the money? It's the time to spend, right? My wants are unlimited. I will go to borrow because the rates are low. High rates of return increase saving but reduce borrowing. I know that this time is not good for me. 20 despite of 3%, they are asking for 30%. Now I will save. I will not spend more. I will not borrow. The equilibrium interest rate is the rate at which the amount individual, business and government desire to borrow is equal to the amount that individuals, business and government desire to lend. Once again, what is equilibrium interest rate? Rate at which the amount individual, business and government desire to borrow is equal to the amount that individual, business and government desire to lend. So this rate is borrow is to lend. So they are talking about desire. I wanted 3%. You also take it 3%. It's the equilibrium rate of interest. Bank are providing at 6%. Okay, I am willing to take it 6%. Okay. Banks are giving at 10%. I don't agree. This is high. So I will save more, borrow less. So there is a disequilibrium. So when the two parties are satisfied with the rate of interest, this is known as equilibrium interest rate. Equilibrium rate for different types of borrowing and lending will differ due to difference in risk, liquidity and maturity. So it depends. Now we are talking about the last functions of financial capital, that is allocation of capital. With limited availability of capital, one of the most important function of a financial system is to allocate capital to its most efficient use. Simple logic. Okay. Investors weigh the expected risk and return of different investment to determine their most preferred investment. As long as investors are well informed regarding risk and returns and market function well, this results in an allocation to capital to its most valuable uses. Simple, it's a basic paragraph, nothing more, nothing more complicated. So LOS1, there are three main functions of financial system. One is allow entities to save, borrow, raise, manage risk and trade asset. Simple. Second is total demand of saving should be equal to total demand of borrowing, and if both the parties are willing, that's the equilibrium rate of interest, the rate at which the borrower and the lender are both satisfied, that is equilibrium rate of interest. Now allocation of capital should be to its most efficient utilization of the resource. Now second is describe classification of assets and market. Now let's go into what are the classification of assets, what are the classification of markets. So another main topic, classification of assets and markets. Okay, now financial assets include securities, stocks and bonds, derivative contracts and currencies. So there are two types of assets. Now we are learning on classification of assets. So there are two classifications, financial assets and real assets. So financial asset and real assets. Now financial assets, what all they include? Securities, okay, which include stocks and bonds, derivative contract, okay, you are trading in stocks, you are trading in bonds, you are trading in derivatives, you are trading in currencies, you are all trading in financial assets. Now if you are trading in other than financial assets like real assets, equipments, commodities and other physical, rest all physical assets, okay, real asset is physical, equipments is physical, commodities is physical, so all physical assets come under real assets. Security you cannot touch, derivatives you cannot touch, like stocks and bonds you cannot touch, derivatives you cannot touch, currencies also you cannot touch. So what all assets you cannot touch comes under financial assets, what all you can touch that come under real assets, that too depends, you should apply logic to. So this part is very much clear, I guess, financial assets and real assets. Now financial securities, now we are going in depth. Financial securities can be classified as debt or equity. Now we told that financial assets include securities which are stocks and bonds, okay. Now it can be debt security or equity security. Debt security means that promises to repay fund. Equity securities means represents ownership, like I want to raise the fund, I raise the bond. I own a Reliance share means I am holding, I am an owner of an I own a ownership in the Reliance company, okay. Now public traded securities are traded on exchange through securities dealers and are subject to regulatory oversight. Securities that are not traded in public markets are referred to as private securities. Okay, private securities are often illiquid and often subject to regulation. Now I am buying a Reliance share, that is public security, and I am buying a pre-market IPO, okay. I am buying like a SpaceX share which is not listed in the US market. It is private security, it's often illiquid and not subject to regulation, like GMP prices you have seen which are not listed in the markets. Now derivative contract, okay, we are moving to derivatives. Derivative contract have value that depends on the are derived from the value of other assets, like Nifty futures, it's a derivative. so its value is derived from underlying of Nifty. Financial derivative contracts are based on equities, equity indexes, debt indexes, or other financial contracts. Physical derivative contract derive their value from value of the physical assets such as gold, oil, and wheat. So there are financial and physical derivatives. Now, what all you can touch is physical derivative contract. What all you cannot touch is financial derivative contract. Market for immediate delivery are referred to as spot market. What is known as spot market? You can have immediate delivery. Contract for the future delivery of physical and financial assets include forward, futures, and options. Option provide the buyer the right but not the obligation to purchase, sell asset or some period at a predetermined price. The primary market is the market. So we are learning about the primary market and secondary market. So here we come on the classification on markets. Now we learned about spot market. Now we learn about primary and secondary. When the shares are issued for the first time, like an IPO, it's known as primary, newly issued securities. Now the securities have come to the market. Now everybody is transacting with each other in the exchange. It is known as secondary market. It can be an exchange or outside. Money market and capital market, simple, which is settled within 1 year is known as money market. Which maturity lasts longer than 1 year, capital market. You are buying a 3-month commercial paper, that is a money market. You are buying a stock for more than 1 year, that is you are buying in a capital market. Okay, so spot market we covered, primary, secondary, money, capital. Now traditional investment market refers to those debt and equity. So what all market come under debt and equity? It is traditional. Rest all come under alternative, like hedge fund, commodity, real estate, collectible, gemstones, leases, equipment. Alternative assets are often more difficult to value, illiquid, require investors' due diligence, and therefore often sell at a discount because its valuation is very tough. So we are let's summarize. Classification of assets and markets was the topic. Okay, right? So if I want to classify the portion, classify on asset and market, you can take it down. Asset, what all I learned? There is financial asset, there are real asset. What all I cannot touch, what I can touch. There are debt security, there are equity security, there are public security, there is private security. Then I have learned about financial derivative. Then I learned about physical derivative. Okay, then I learned about market. What all I learned? I learned about spot market. I learned about primary. Spot market, which I can have immediate delivery. Okay, equity cash, futures, option, which all are spot market. Primary market and secondary market, when the securities are raised for first time in the public, primary. When after first time issuing, you can have sell to second to third to fourth to unlimited number of sellers, buyers. So it's known as secondary. Now what we have next learned, there is type of money market and capital market. What is money market? Which is settled within 1 year, more than 1 year is capital. There is one more market, that is traditional and alternative type of investments. Okay, which deals in debt and equity is traditional. Alternative, all the securities which are not debt and securities are alternative. So we have completed here LOS 2. These LOS, second LOS was comparatively more simpler. Now major types of securities. Now we are moving on We learned on classification of assets and market. We learned on three functions of financial system. Now we are moving to describe the major types of securities, currencies, contract, commodity, real estate that can trade in organized market, including the distinguished characteristics and major subtypes. Okay, now we are moving to types of the instruments over here. So now let's move to LOS3. Okay, now assets can be classified as securities, currencies, contracts, commodities, and real assets. Okay, so assets can be classified as security. Now we are moving on assets. It can be classified as security, it can be classified as currencies, it can be classified as contracts, it can be classified as commodity. So till 2023-24, so there was SEC chairman in US, Gary Gensler. He used to fight. The Bitcoin was a commodity, it was not a security. Ethereum was a commodity, not a security. He fought a lot, but in the end, verdict was opposite. So everything, taxation, regulation, everything is dependent on the type of security. So we need to learn in depth what do they mean. Securities can be classified as fixed income or equity securities. Okay, now we are learning on security. Security can be fixed income or equity. Okay, it can be fixed income and equity. Individual securities can be combined in pooled investment vehicles. So everyone is giving funds to mutual fund. Everyone is depositing, let's say 100 rupees. Now the mutual fund manager is actually pooling them. Corporations and governments are most common issuers of individual securities. The initial sale of a security is called an issue. I am a private owner, company owner, and I am making a public issue. That is IPO. So the initial sale, initial means the first primary sale of a security is known as a issue, when the security is sold to the public. Okay, so it's not only talking about the IPO, not only talking about the stock, talking about everything. Every security, when it is issued to the public for the first time, is known as an issue. Now let's talk about fixed income in depth. Fixed income securities. Fixed income security typically refers to debt securities that are promises to repay borrow money in the future. Okay, fixed income is equal to debt, loan. Okay, so short-term fixed income security generally have a maturity of less than 1 or 2 years. So short-term fixed income is not limited to 1 year, it also limited to 1 or 2 years. Remember that it's a different thing we are saying. 2 years a loan is there, that is also fixed income security, not a long term. Long term maturity are longer than 5 to 10 years. See, long term maturities are more than 5 year only. Intermediary term maturities fall in the middle of the maturity range. So there is a number line 1, 2, 3, 4, 5, blah 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 blah. So 1 to 2 is short, 3 to 4 is intermediary, apart from 5 is only a long term fixed income security. Okay, so we have to learn these jargons. It's a separate 5 years. Long term is not 1 year, it's 5 years. Although, okay, short term is 2 years, although the term are used loosely. Bonds are generally long term, whereas notes are intermediate term. Bonds, if anyone say bonds, that is long term. If anyone say notes, that is intermediate term. What is intermediate term? 3, 4, 5 years. Commercial papers refer to short term. What is short term? 1, 2. So CP is short term, 1 to 2 years. If anyone say notes, that is 3 to 5 years. When anyone say bond from hereafter, that is 5 plus years tenure, maturity. Okay, and I write it down. It's a good knowledge. Then government issues bills and banks issue certificate of deposits. When government issues, it's a bill.